Welcome to my live teaching learning session of Principles of Macroeconomics BECC 133. Today, we will discuss about fiscal policy in Keynesian model and theory of money. Fiscal policy in Keynesian model. Under this topic, we will study about introduction of fiscal policy. It means what is fiscal policy, what is the tools of fiscal policy, the government sector, what role government sector play in each and every economy. Next is automatic stabilizer. What is the meaning of this automatic stabilizer and how it works? What is government budget and what is balanced budget multiplier? Fiscal policy in Keynesian model covers all these topics. And theory of money will cover definition, what is money, how we can define money, what are the main functions of money, and what is the importance or significance of money in our economy. So these topics we will discuss about all in this session. Next is meaning of fiscal policy. Now let us start with the meaning of fiscal policy. What is fiscal policy? Fiscal policy in simple words is that policy which is made by government. It refers to a policy concerning the use of state treasury or the government finance to achieve the macroeconomic goals. As we know that at present, all the economies have government, and government play very important role in the achievement of economic goals. And in macroeconomics, government sector always play very important role to stabilize the economic growth, to stabilize the economic fluctuations. If economy is in fluctuation, then how we can stabilize? Government policy or fiscal policy tells us about this. And how we can achieve the goal of equal distribution of income and wealth. With the help of this fiscal policy, inequality can be reduced and equal distribution of income and wealth can be done. With the help of this fiscal policy, government can generate more employment opportunities to reduce the problem of unemployment. Each and every economy wants to achieve high growth rate of economic development. And how this economic development rate can achieve? Fiscal policy is very important tool or play very important role in the achievement of these macroeconomic goals. Or in other words, we can say that fiscal policy is government policy through which government can change its taxation and public expenditure programs intended to achieve its objectives. The main tools of fiscal policy are public revenue, second is public expenditure, third is public debt, and fourth is public budget or government budget. The main four tools exist in fiscal policy or included in fiscal policy. Government can increase their revenue through taxation or non-taxation sources. The main source of public revenue is taxation. But government can collect revenue through other sources also. For example, non-taxable sources are also the main source of public revenue. And government collect income through these sources and spend money on development and non-development works for the development of the country. Government can provide roads, bridges, flyovers, education, health facility, infrastructural facilities, irrigation facility, and government spend money on these development works for the sake of the welfare of the country people. And government spend money on defense purpose or defense equipments like weapons, missiles, guns, and government can spend money to maintain law and order in the economy and to give justice to the country people, so that government have to spend money on development and non-development functions works. Government can spend money on planned or unplanned way. So government policy is that policy which include public revenue, public expenditure, and public debt. What is public debt? Public debt is the borrowings from internal and external sources. We know that government has unlimited powers. Government can take borrowing from internal sources as well as from external sources. So, public debt include all types of borrowing from internal and external sources. And in budget, government always make budget which represent expected public expenditures and expected public revenue in an accounting year. So government policy is that policy in which government uses its income on expenditure or on public development works to produce desirable effects on national income, production, and employment. So this is the fiscal policy, meaning which refers to the use of government fund or state treasury or government finance to the achievement of macroeconomic goals. Because we are studying about macroeconomics, macroeconomics deals with whole units of the economy. If government want to achieve all these goals, then government has to make fiscal policy. Next is public sector. What is public sector or government sector? In our economy, here federal economic system is existing. Federal government or federal economic system is that system in which central government, state government, and local government all are included. In some countries, there are single government system. But in our economy, here federal government system exists. Federal system or federal government is that economy or federal system is that system in which all types of government sector included. For example, central government play very important role in our country. Central government has too much powers. Central government can collect revenue from so many sources, and central government can collect fund or grants from external sector also. So central government has lot of power to collect revenue from internal sources as well as from external sources. But the functions of central governments are less. And state government is that government which play important role in states. In India, here 29 states are there. In each and every state, state government play very important role for the development of the state or country people of the state. And local government also play very important role in our economy. economy. Local government is that government in which municipal corporation and district level all are included. So public sector include three types of government in which central government, state government and local government play very important role in Indian economy in which federal government system exists. All these make public corporations. Next is automatic stabilizer. What is automatic stabilizer? The It is clear from its name, it is automatic. Automatic means which works automatically without any interference of the government. If government policy tools like public expenditure, public revenue, public debt all play role automatically to stabilize the economy and to stabilize the all fluctuations, to reduce all fluctuations which occur time to time like boom, recession, depression and recovery. These are the four stages of business cycles and these cycles occur from time to time. And Schumpeter, who was great economist, introduced these business cycles and he explained that business cycles has four stages. In first stage, boom occur. In second stage, recession. And in third stage, depression exists. And in fourth stage, recovery. So automatic stabilizer is that stabilizer in which fiscal policy instruments or fiscal policy tools like public revenue, public expenditure, public debt all influence the rate of GDP growth and help counter swings in the business cycle. For example, if inflation exists in our economy, inflation is that situation in which price continuously rises. When price rises continuously or persistently, that situation is known as inflation. During the period of inflation, if government want to reduce this inflation situation, then fiscal policy tools like public revenue and public expenditure, public debt, if all works automatically to stabilize the situation of the economy, then it will be called automatic stabilizer. Automatic stabilizer play automatically work to stabilize the economy. Like if public expenditure reduces at the time of inflation and public revenue, which government collect through taxation, increases, it means inflation problem will be solved and economy will automatically achieve at the rate of stabilized economic growth and prices will be controlled. And if there is deflation exists in the economy, then fiscal policy tools like public expenditure, public revenue, public debt work automatically. In case of deflation, public expenditure will increase and public revenue will fall and public debt will also rise. In this case, deflation situation will be controlled automatically. So these instruments of fiscal policy, if work automatically to stabilize the economy and to control the inflation or deflation situation which occurs time to time in our economy, that policy is called automatic stabilizer, which works automatically to stabilize the economy. And automatic stabilizer can easily control all the fluctuations of the economy which occurs time to time very smoothly. So it play very important role, automatic stabilizer. Next is automatic stabilizer. We can define in this form also: the tools of fiscal policy embedded in the economy that respond to the different phases of the business cycle. They are automatic because they adjust without an action by government or the president. And they serve as stabilizers because they limit the increase in real GDP during expansions and reduce the decrease in real GDP during recession. During expansion or during extension period, GDP is increases and real GDP decreases at the time of recession. But if government policy or fiscal policy tools work automatically, they can maintain the balance between real GDP and control the fluctuations of increase or decrease. That is called automatic stabilizer. So automatic stabilizer is very helpful to control the existing or prevailing business cycle situation in the economy, and they work automatically. That's why it is called automatic, and it serves as stabilizer and to stabilize the situation of the economy. That's why word is used stabilizer. So this is the meaning of automatic stabilizer, in which fiscal policy tools work automatically to stabilize or to achieve macroeconomic goals. Next is, what is government budget? Government budget is very important tool of fiscal policy. As you know that government always make budget. Budget is a record of all the government expenditures and government revenues in an accounting year. Under this topic, we will study about what is government budget, what are the sources of government revenue, how does government allocate its revenue, what is the difference between deficit and debt, and why does running a deficit matter? The first question is, what are the sources of government revenue? The main sources of government revenues are taxation, and second other source is non-taxable source of public revenue. In taxable source of public revenue, we include direct taxes and indirect taxes. Direct taxes are those taxes whose burden falls on same person, and the first burden of the tax and the last burden of the tax, if falls on same person, that tax is called direct tax. For example, income tax, gift tax, wealth tax, property tax is known as direct taxes. In case of direct taxes, the impact of tax is first burden of tax, and incidence of tax, which shows the last burden of tax. In case of direct taxes, first burden of tax and last burden of tax bear by same person on which tax is imposed. But in case of indirect taxes, the first burden of the tax will bear by producer, and the last burden of the tax will bear by consumer. Direct taxes can't be shiftable, but indirect taxes can be shiftable from producer to consumer. So indirect taxes at present, GST is known as indirect tax. Excise duty is called indirect tax. GST, under this we include central government goods and services tax, and state government goods and services tax. So government revenue sources include taxation sources and non-taxable sources. Non-taxable source of revenue includes fees, fines, public enterprises surpluses, grant, gift, estate, special assessment, etc. In which fees government collect fees from government institutions like schools, colleges. Government collect fees from students. That is the source of income of the government. And second is fines. Government take income from through penalty if any country people break the rules of the economy or justice, they don't follow the rules of traffic or others, then public has to pay penalty. That is the source of income of the government. And third is estate. Estate means if a person died without expressing or without giving the name of nominee, after his death, government take that asset in control of themselves. In this case, when government collect income from the person who died without giving the name of any nominee and without any claimer, that property goes to government hand. That is the source of income of the government. And next is special assessment. If from government work, if any property value increases, then government take special assessment or government take property tax with doing some increment or from some special assessment. This is also the source of income of the government. And grants, gifts, donation, and surplus of public enterprises is also non-taxable source of public revenue. Next is how does the government allocate its revenue? How government allocate its revenue? It means how government spend this money which is collected through taxation or non-taxation sources. In this, government spend money on development works and on non-development works. Development works are like education facility to provide medical facility, irrigation facility, roads, bridges, flyovers, water supply, electricity. All these works are known as development works, and government can spend money on non-development works like defense to maintain law and order in the economy. That is called non-development expenditure. Government spend money on these development or non-development works. So government should allocate its revenue in such a manner inequalities of income and wealth can be reduced. It means government should allocate its revenue or funds in that manner in which resources can be used by all, not by only individual person. Next question is, what is the difference between deficit and debt? Deficit means the loss of government budget when public expenditures are greater than public revenue, then government budget will be in deficit situation. And debt is borrowings. Debt is called borrowings. Government can take borrowings from internal and external sources. Because government has unlimited power, that's why government can collect debt from external and internal, both the sources. Debt is the source of income and deficit occurs at that time when expenditures are more than revenues. So this is the basic difference between deficit and debt. And why does running a deficit matter? In our economy, government always spend more and collect less revenue. That's why deficit or budget deficit occurs time to time. So deficit means government is spending more. As we know that one person expenditure is another person income. If government spend more money, then public income will rise. If public income will rise, country people will earn more, then they can spend also more. If their spending power will increase, then in economy, production will increase, investment will increase, and employment will generate. It means government deficit is not bad in each and every situation of the economy. Sometimes it is good because in this case, government spending a lot of money on public works and for the development of the country. But if we always make deficit budget and to compensate this budget, if RBI issues paper currency, coins, notes, etc. continuously, in this case, money supply will rise, purchasing power of the country people will rise, but we know that resources are limited, so supply of the goods and services can't increase according to the increasing demand. In this case, inflation will occur. Inflation will adversely affects our balance of payment. If inflation occurs in our economy, then our exports will fall, imports will rise. In this case, balance of payment will be unfavorable. So if deficit occurs in a limited time period, that is good. And if deficit financing through printing of new paper currency, RBI is doing continuously, that is bad for the economy. So deficit or deficit financing should be used as a medicine, not as a food. So this is known as government budget, which tells us the answers of all these questions, like what are the sources of public revenue, what is the difference between deficit and debt, and how government allocate its revenue, and why does running a deficit matter. All these answers we can get through the study of government budget. Next is government budget should be in balance, but it should be in balance at that time when government receipts or government revenues and government expenditures, if both are equal, then government budget will be known as balanced budget. But in India, budget remains always unbalanced. Sometimes surplus budget government make and sometimes deficit budget government make. Balanced budget is that situation in which receipts and expenditures both are equal. But deficit budget occur when public expenditures are more than public revenues. And surplus budget is that situation when government receipts or government revenues are more than government expenditures. The budget may be in surplus or maybe in deficit or maybe in balance. Depends upon public revenue and public expenditures. Public revenue, under this we include revenue. Public revenue means taxation. Government can collect income through taxation. And revenue may be two. One is capital revenue and second is revenue receipts, and capital receipts both are included in revenue. And revenue expenditure and capital expenditure both are included in expenditure or public expenditure. Next is, what is the balanced budget multiplier? Balanced budget multiplier shows the balance in public expenditure and balanced in public revenue. An equal change in government spending and taxes, which changes aggregate demand by the amount of the change in government spending. If the government revenue is same as government expenditure, then budget will be in balance. For example, if our income is 10,000 and our expenditure is also 10,000 rupees, then budget will be in balance, and the value of balanced budget multiplier will always remains equals to unity or 1. So balanced budget multiplier shows the equal change in government spending and equal change in taxes, which changes aggregate demand by the same amount of government spending. We can show balanced budget multiplier with the help of this formula. Here K denotes multiplier and B is balanced budget. So KB is balanced budget multiplier is equals to KG. KG is government spending multiplier plus KT shows tax multiplier. Government balanced budget multiplier is the summation of government spending multiplier and government taxation multiplier. So KG shows government spending multiplier and KT shows tax multiplier. The value of KG is equals to 1 upon MPS. Here MPS is marginal propensity to save, and the formula of calculating tax multiplier is minus MPC upon MPS. Minus MPC upon MPS. MPC is marginal propensity to consume and MPS is marginal propensity to save. Now, if we add both formulas of government spending and tax, then we can get the value of this 1 upon MPS plus minus will be equals to minus. So value will be in between of this minus MPC upon MPS. If we take LCM, MPS, it means it will remain same MPS and in above 1 minus MPC. So in denominator we will take MPS and in numerator we will take 1 minus MPC. And as you know that in consumption function chapter, you have studied about the relationship between MPC and MPS. MPC and MPS summation is always equals to 1. If we want to calculate MPC, then 1 minus MPS can be done, and 1 minus MPC is always equals to MPS. So 1 minus MPC is equals to MPS. So value will be MPS upon MPS. Both will cut and the value will be equals to 1. So balanced budget multiplier is always equals to 1 and always remains unity. That is the formula of calculating balanced budget multiplier. Next is balanced budget multiplier. We can define in this form also. If government spending multiplier is 1 upon 1 minus B, here B representing MPC. B is MPC, marginal propensity to consume. And government spending multiplier is always equals to 1 upon 1 minus MPC or 1 upon MPS. And the government taxation multiplier is equals to minus B upon 1 minus B. Minus B is minus MPC upon 1 minus B matlab MPS. Then we can see just how much a balanced budget would stimulate the economy. Where G is equals to T, the effects added together are 1 upon 1 minus B plus minus B upon 1 minus B. So 1 minus B upon 1 minus B, both will be cancelled and the value will be we will get 1. So balanced budget multiplier is always equals to unity or 1. And it occurs when government spending and government revenues both are equal. We can show this balanced budget multiplier with the help of this diagram. Here, 45-degree line shows aggregate supply, which has two components, consumption and saving. Next is C1. C shows consumption line, As you know that consumption can never be zero. That's why consumption curve always start from the y-axis, not from the origin. And where consumption curve intersects this income line or aggregate supply line, D point will be determined. And if we take C plus I plus G three sector model, and three sector model, in this case consumption curve will shift to the upward and it intersect aggregate supply curve at point F. Here equilibrium point will be determined and equilibrium level of income will be determined B. But in case of D point, equilibrium level of income was A. So if there is increase in government expenditure, then income will increase by the same ratio. That is called balanced budget multiplier. It means the ratio from which government spending is increasing is same as the ratio of income which is increasing after government expenditure. So if government expenditure and change in income both are equal, or delta y upon delta g, it means if change in income and change in government expenditure, change in income and change in tax rate all are equal, then budget will be in balance. So balanced budget multiplier always represent the same ratio of government expenditures and government revenues. Next is the conclusion of this fiscal policies. So fiscal policy is more successful policy in controlling depression. Fiscal policy does not provide a complete substitute for sound monetary policy. Fiscal policy and monetary policy both are complementary to each other but not substitutable. The effects of fiscal policy are more direct because as it involves shaping of the tax structure, determination of the amount of tax revenue and volume as well as direction of public expenditure. So in fiscal policy chapter, you have studied about that what is fiscal policy, what are the tools of fiscal policy, and how fiscal policy can achieve macroeconomic goals and to stabilize the economy in situation of business cycles, and what is balanced budget multiplier and how balanced budget multiplier can be calculated with the help of formula. So all these topics are included in fiscal policy in Keynesian model. Now next topic is money. What is money? The meaning of money is what money does. This definition was given by Professor Walker. He said that in simple words, what is money? Money is what money does. And the difference between money and wealth. Here, money is a very liquid asset, but wealth is not a liquid asset, same as money. If you have property, you have share, debentures, paper title documents, or fixed deposit paper, or FD certificate, or NSC certificate, National Savings Certificate, etc. That will be called wealth. And wealth is not as much liquid as money. So money and wealth are often confused. This section will tell you what is money. This section of the module provides a very easy way to separate money from the other assets that have value. Next is what is money, how we can define money. It is almost impossible to define money in terms of its physical form or properties since these are so diverse. Therefore, any definition must be based on its functions. First of all, money is defined by Professor Walker, and according to him, money is what money does. But this definition was not completed, was incomplete definition. After that, Professor Kinley defined money according to the functions of money, and Kinley classified the functions of money in four, that money has four functions: medium, measure, store, and standard. Money is used as a medium of exchange. In simple words, we can say that what is money? Money is a medium of exchange through which we can sell or purchase any type of goods and services in the economy. Money is generally acceptable by all. Each and every person easily accept money. If you give checks or paper title documents like shares, bonds, debentures, or other things which are not as liquid as money, some people can refuse to accept it. But money is accepted by all. Next is money has a store of value. You can easily store money. Money can be easily storable without using godowns or without using warehouses. Money can be easily storable. Next is money is a unit of account. For example, in this function of unit of account, each and every commodity which produce in our economy, we can measure in terms of money. As you know that distance is calculated, or distance measuring unit is kilometer, weight measuring unit is kilogram, milk is measured in units of liter, cloth is measured in units of meter, same as each and every commodity which are produced in our economy, that can be measured in terms of money. So money is a medium of exchange. Money has a store of value. Money is easily acceptable by all. Money is a unit of account. Money can be used as a deferred payment. Here, deferred means postponed, and payment means the payment which we give to another person. So, deferred payment means postponed payments which are not made in present, which will do in future. That payment can also be do with the help of or give with the help of money. So money is very helpful in all these performing all these functions of the economy. So every economics give different aspects of money and give only the definition of money to take one function of the money. But Professor Seligman and Professor Crowther has given the best definition of money. Crowther gave the best definition of money in which all functions of money included. For example, money is a simple medium of exchange which is accepted by all. Money has a store of value. Money can be easily transferable from one place to another place. Money can be used as a deferred payment, and money is a unit of account. So these are the functions of money, or we can define the definition of money to take functions of money. Without taking functions, we can't define money, because money is useless if it has no power of purchasing. It has purchasing power. That's why people demand for money. If money has nothing power, money cannot buy anything, then people will not demand money. But now, at present, money can purchase each and everything. That's why everybody demands money. Money is a medium of exchange. Economics tends to define money is anything. Money is anything like paper title documents, papers. Money can be in form of paper, notes. Money can be in form of coins, which is prevailing in our economy at present. But earlier it was barter system. Barter system, when money was disappeared, money was not existed at that time. People use for change and exchange only goods and services. That system is known as barter system. And under barter system, there were so many problems like double coincidence of wants. It means if you have wheat and other person has rice, then you can sell or purchase wheat and rice and change or exchange your goods and services with the help of goods. That is called barter. But if you want to take rice from that person, but that person will not want to buy your wheat, then how the exchange will be possible, how transactions will be held. So barter system has so many difficulties. That's why the origin of money occurs in our economy. Before the origin of money, there was barter system. After that, metallic money was existed in our economy. And after that, paper currency, coins, notes, etc., which are prevailing at present, we are using the mode of payment, coins, paper currency, etc. That is called money. Economics tend to define that money is anything which is readily acceptable as a means of payment. Usually, this means notes, coins, bank deposits, etc. However, one authority says it is an extremely difficult concept to define with precise way. The supply of money comes under any number of definitions. Next is money and the monetary system. Definition of money in simple words: money is any commodity or token that is generally accepted as a means of payment. Money is an institution, human societies devised to reduce transaction cost. Money perform mainly three functions. One is medium of exchange, second is unit of account, and third is store of value. We will discuss in detailed form of all these functions. Medium of exchange. These three functions are medium of exchange. Second is unit of account and third is store of value. In medium of exchange, as a medium of exchange, money measures the value during the exchange of goods and services. As a medium of exchange, money can be used for sale and purchase of each and every commodity which are produced in our country. And second function, unit of value, it means we can compare the value of each and every commodity which produced in our country. It tells us about how much expensive price tag tells us something about the good value. It means here one commodity price is 30 and other is 44. It means the value of that jacket is $44 and one jacket is $30. It shows us the unit of value, and we can compare the unit of value with the help of money. Third is store of value. Money can be easily storable without the need of warehouses and godowns. Money holds its value even if it is not used immediately to buy goods and services, unless very high inflation occurs. It means money value remains constant. Money is not reducible, the value of it. So money can be easily storable without any problem. These are the three main functions of money. Next is types of money. There are so many types of money. Before this coins, paper currency origin, there were so many types of money was existed in our economy. First was commodity money. Commodity money is that money which has value apart from its use as money. For example, gold, silver, that is called commodity money or metallic money, or goods and services can also be used as a money. At before the origin of money, barter system was prevailing in our economy. Next is fiat money. Fiat money is that money that some authority, generally like government, has ordered to be accepted as a medium of exchange. For example, paper money, coins in the US, this note is legal tender for all debts, public and private. Currency means paper currency, coins, etc. Checkable deposits are balances in checking accounts. And check means a written order to a bank to transfer ownership of a checkable deposit. These are the types of money. Next is significance of money. Significance of money tells us the importance of money. What is the important role money play in our economy? As you know that there are three basic economic activities. One is production, second is consumption, third is investment, fourth is exchange, and fifth is public revenue or public finance. To performing all these economic activities smoothly, money is very helpful. Without money, producer can't produce goods and services. Without money, consumer can't satisfy his basic needs or requirements. Without money, change and exchange of goods and services can't be possible. Without money, investment can't be possible. Means producer can't invest money in business if money does not exist in the economy. And without money, distribution is also not possible. Distribution means the distribution of national income among factors of production. Factors of productions are four, like land, labor, capital, entrepreneur, which give their contribution in the production of goods and services. With the help of money, they take reward in form of wages, interest, profit, and rent. All these factors of production get reward in money form after rendering their services in the production of goods and services. So, money play very important role in production. Money play very important role in consumption. With the help of money, consumer can maximize his satisfaction through minimum spending. Producer can get maximum output at minimum cost. Goods and services sale and purchase can be possible with the help of money. And with the help of money, investment can be possible. All goods and services which are produced by the businessman, they can invest more money or more fixed assets in their business with the help of money. Money is very helpful in public finance also. Public finance is very a broader concept in which public revenue, public expenditure, public debt, and budget all are included. And with the help of money, government impose taxes on consumers and producers, and government spend money on development and non-development works. So money is very important and it play very important role in each and every economic activity, in each and every economy. Either economy may be capitalist, may be socialist, or may be mixed. In all types of economy, money play very important role. The first significance of money is that money eliminates the problem of barter system. Second is money works as a fifth factor of production. We know that factors of productions are four: land, labor, capital, and entrepreneur. But in this four factors of production, money works very efficiently and money manage all these factors of production very efficiently in the production of goods and services. So money works as the fifth factor of production. Money accelerates the pace of production and growth by making factor payment and sale of products quick and in efficient manner. Money is the lifeblood of the modern economy. Money facilitates consumers' choice. With the help of money, consumer have so many options. If consumer has money, then he has so many options. Either he can use his money in any other thing or in another thing. So money facilitate consumers' choices. Money market and credit system evolution resulting in efficient system of financial flow of money to various sectors of the economy. Money is the basis of credit. Without money, commercial bank can't create credit. So money play very important role in each and every economic system. Next is pros and cons of money. Each and everything has merits and demerits also. Same as money has also some merits and some demerits. In merits, money gives you freedom. It means with the help of money, you can buy each and everything. You have freedom. What you want to do, you can do with the help of money. Money helps you to afford a desirable lifestyle. Money allows you to pursue your dreams. You can fulfill your all dreams with the help of money. And money gives you a sense of security. If you have money and if you are financially strong, then you feel secure. You feel that your future will be secure. But if you don't have money, you will feel unsecure. You can't fulfill your dreams without money. You can't get your desirable lifestyle without money. And you can't get freedom without money. So money is very useful and very important. But cons are or demerits are money can be a reason for obsession. Money makes people greedy. And all the crimes, the main cause behind all crimes are money. Money is not necessary for pursuit of wealth leads to corruption. People will become more corrupted when they want to get more money or immediate money without doing any efforts, without doing any work. A desire for money can cause conflicts. Money is very main cause of conflicts. So money can be used as a servant, but not as a master. Money is very useful. We can't deny this thing that money is very important and play very important role in our economy, but it has some disadvantages also. So we should use money as a servant, not as a master. If money will become as a master, then it will force us to do crimes. So money should be used efficiently and for the fulfillment of our wants. Conclusion. Paper money is a source of blessing for mankind. However, when it is not properly managed, it becomes source of risk and confusion. So paper money which we are using, it has no intrinsic value. It can't be used in any another form. That's why here paper currency, coins, notes, etc., which we are using at present for as a medium of exchange, that is a source of blessing for mankind, and it is very useful for performing all the functions of the economy like production, consumption, investment, exchange, and distribution or public finance. So money play very important role. Thank you.